Welcome to the video. Today we'll clarify one of the most misunderstood parts of U.S. personal finance: taxes when you live abroad. To smoothly begin, let's set expectations. The United States uses citizen-based taxation. That means, if you are a U.S. citizen, you generally must file a federal tax return every year, no matter where you live or earn your income. We'll unpack the Foreign Earned Income Exclusion, when it helps, when it doesn't, how self-employment tax can still hit you, what counts as unearned income, and an action plan to stay compliant. Let's move forward with an agenda to guide our journey. Here's our roadmap. First, we address the myth versus reality. Next, we explain the unavoidable filing rule. Then, we detail the FEIE and its limitations. After that, we walk through the self-employment tax trap and break down income types. Subsequently, we turn to a practical compliance action plan and a quick case study. Finally, we test your understanding with a short quiz, summarize the key takeaways, and provide an important disclaimer. Let's begin by contrasting a common myth with reality. The myth says that moving abroad frees U.S. citizens from U.S. taxes. In reality, the U.S. tax system is citizen-based. If you hold a U.S. passport, you generally must file annually, regardless of where you live or where your income is earned. With that foundation, we can smoothly transition to the central filing rule that governs expat obligations. Here is the filing rule. If you are a U.S. citizen and your income exceeds the applicable filing threshold, you must file a federal return. Your physical location outside the United States does not eliminate this requirement. From there, you should assess whether you qualify for the Foreign Earned Income Exclusion or foreign tax credits to reduce income tax. Importantly, even when income tax is reduced by the exclusion, self-employment income can still lead to self-employment tax. Now, let's move into how FEIE actually works and what it does not cover. This flowchart starts by asking whether you are a U.S. citizen or resident alien. If the answer is yes, and your worldwide income exceeds the filing threshold, you must file Form 1040. From there, it branches into categories. Earned foreign wages may qualify for the Foreign Earned Income Exclusion, subject to eligibility tests like the bona fide residence or the physical presence test. A note clarifies the approximate FEIE amount for 2026, and that it applies only to earned income. Another branch addresses self-employment income, emphasizing that self-employment tax applies even if the underlying income is excluded by FEIE. A separate branch covers unearned income, such as investments, pensions, and taxable scholarships, which remain taxable. Finally, the flowchart highlights that you may consider the foreign tax credit if you paid foreign income taxes, maintain documentation, and file any required information reports like FBAR or FATCA where applicable. With that overview, we can now zoom in on FEIE's scope and limits. The Foreign Earned Income Exclusion applies to earned income from services performed abroad. It can exclude a significant portion of wages, but it has strict limits. It does not apply to unearned income, such as investment gains, pensions, or taxable scholarships. Equally important, the exclusion does not remove the obligation to pay U.S. self-employment tax on net self-employment earnings. You generally must qualify under either the physical presence test or the bona fide residence test, and there is an annual limit on the exclusion amount with separate housing provisions. To deepen understanding, let's compare FEIE to another relief mechanism often considered by expats: the foreign tax credit. On the left, FEIE can exclude a capped amount of foreign earned income if you meet either the physical presence test or the bona fide residence test. It does not apply to unearned income and does not eliminate self-employment tax. On the right, the foreign tax credit allows you to claim a credit for foreign income taxes paid, which can apply to both earned and many unearned income types. It does not require day count tests, but still does not address self-employment tax or non-income levies. Practically, some taxpayers model both approaches to determine which combination yields the lowest U.S. tax while remaining compliant. Next, let's categorize income types to understand what's typically covered and what is not. This table maps common income categories to their typical U.S. tax treatment. Foreign wages as an employee are often eligible for the FEIE up to the annual cap, potentially with a housing exclusion, and usually do not create self-employment tax. Freelance or consulting income earned abroad is still subject to self-employment tax, even if FEIE excludes the income for income tax purposes. Investment gains and dividends, pensions, annuities, and taxable scholarships are not eligible for FEIE and remain taxable in the U.S. U.S. source income generally is not eligible for FEIE and remains fully taxable based on source rules. With these categories in mind, let's move to an actionable compliance plan. Follow a clear plan. First, track your days abroad to test FEIE eligibility. Second, separate income streams so you can apply the correct rules to each category. Third, retain documentation including payslips, contracts, invoices, and proof of foreign taxes paid. Fourth, model FEIE versus foreign tax credit outcomes, or a combination using reliable tools or a qualified advisor. Fifth, proactively plan for self-employment tax if you have freelance or consulting income. Sixth, calendar filing and payment deadlines, and remember that extensions do not remove interest or penalties. Seventh, file any information reports such as FBAR or FATCA if you meet the thresholds. Finally, revisit your plan yearly as caps and circumstances evolve. Now, let's solidify the concepts with a quick case study. Consider a U.S. citizen living in Spain, earning the equivalent of 90,000 euros from freelancing. They pay Spanish income tax and have some U.S. clients. They may qualify for the FEIE to exclude some earned income for U.S. income tax purposes, but they still owe U.S. self-employment tax on their net self-employment earnings. They can consider the foreign tax credit for Spanish income taxes paid to offset U.S. income tax, though this does not reduce self-employment tax. A prudent approach is to set aside cash for self-employment tax and make quarterly estimated payments. They should maintain thorough documentation, such as invoices, bank statements, and Spanish tax assessments. To stay eligible for FEIE, they must meet a qualifying test, like the physical presence test. The FEIE cap is approximately $120,000 for 2026. And self-employment tax rates apply subject to Social Security and Medicare rules. With this scenario in mind, let's check your understanding with a short quiz. Quiz time. The question is, if you claim the Foreign Earned Income Exclusion on your freelance income while living abroad, which of the following is still likely due in the United States? The options are A, nothing at all; B, only state income tax; C, self-employment tax, which includes Social Security and Medicare; or D, property tax. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, self-employment tax. The Foreign Earned Income Exclusion can reduce U.S. income tax on earned foreign income, but does not remove the obligation to pay self-employment tax on net self-employment earnings. Next, let's reinforce the difference between earned and unearned income. Here is the second question. Which of the following is generally not excludable under the Foreign Earned Income Exclusion? The options are A, salary from a foreign employer; B, dividends from investments; C, wages performed abroad; or D, a housing exclusion for qualified taxpayers. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, dividends from investments. Unearned income like dividends, capital gains, and pensions does not qualify for the Foreign Earned Income Exclusion. Now, to help you plan over the calendar year, let's visualize deadlines and milestones. This timeline starts with January through March for collecting income statements, foreign tax receipts, and bank documents. The standard U.S. tax deadline is around mid-April, and many expats receive an automatic 2-month extension to file to mid-June, but that does not extend the time to pay. Quarterly estimated payment dates, April, June, September, and mid-January of the following year, are critical for self-employment income. If an extension is filed, the return may be due in mid-October. Throughout the year, track your days abroad for FEIE tests. By December 31st, complete any year-end planning. With the calendar in mind, let's consolidate key points. These are the essential points. The U.S. system is citizen-based, so filing generally remains required. The FEIE can reduce income tax on earned wages but is capped and does not eliminate self-employment tax. Unearned income usually cannot be excluded with FEIE. Maintain detailed records, plan for self-employment tax, and evaluate whether the foreign tax credit, FEIE, or a combination yields the most efficient outcome for your situation. Next, given the legal and financial nature of this topic, we include an important disclaimer. This content is educational and does not constitute tax, legal, or financial advice. Tax laws and thresholds change, and individual circumstances vary significantly. Consult a qualified tax professional who understands cross-border issues before taking action. With that in mind, let's wrap up with a concise summary. In summary, moving abroad does not end U.S. filing obligations for citizens. The Foreign Earned Income Exclusion offers partial relief for earned foreign income, but comes with strict limits. Self-employment tax often still applies to freelance or consulting income, even when the income is excluded from U.S. income tax. Unearned income remains taxable by the United States in most cases. Diligent tracking, documentation, and proactive planning are essential to remain compliant and financially secure. Finally, let's close with a call to action. Thank you for watching. If this was helpful, please like the video, share it with anyone living or moving abroad, and subscribe for more personal finance guidance. Share your questions and experiences in the comments so we can address real-world scenarios in future videos.